On today's episode of the Full Subjects podcast, we are going to be debunking 5 real estate myths. So thanks for joining us for this episode. In our industry, there's a ton of clickbait things that people see or maybe misconceptions with their thoughts that they believe to be true. And we're hoping to explain some of those today so that you can better understand some of these myths and which parts of them are true, which aren't, and just so you have better knowledge going forward. As always, this podcast is for informational purposes only. It does not constitute any legal, tax, investment, financial, or any other advice. It's not intended to cause or induce breach of any existing agency agreement. So happy I nailed that one without fumbling over it. Let's get into it.
All right. Yeah, as Austin said, guys, we're gonna look at some myths. Some of them are gonna be a little bit more obvious than others, but we'll try to provide a little bit more detail for each and why some people might be confused about certain things. So the first one, which most people, I don't know if this one's as big of a myth, but I'd like to kind of talk to it a little bit more and kind of break down more specifics about this one. So number one, Austin, you need 20% to buy, you need 20% down to buy a home. So obviously these are all myths, so we know that none of this is 100% true. Now, what's important to note about this one is it's not entirely false. Like, there is certain circumstances where you do need 20% down to buy a home. So that's actually more recently changed. So we saw in the last, I want to say, how long has it been now?
Basically last calendar year.
Yeah, within the last calendar year, we saw a massive change to insured mortgages. So just really quickly, insured mortgages mean you're putting less than 20% down. And because of that, you're paying an insurance premium in order to have the ability to put less than 20% down. And originally, the cap on that purchase was $1 million, but they've recently raised that cap to $1.5 million. So that's quite a significant change. It significantly decreases the minimum down payment required in order to buy a home up to $1.5 million. And yeah, so getting into this a little bit more, Austin, I'll come back to here in a second, but the other side of this is sometimes you'll see people say this. You'll see, oh, you only need 5% down to buy a home. And again, that is true in some capacities, but there's a limit to how much you can buy. And in our market, there's especially in our market, there's limited options that allow you to do that. So maybe, Austin, I'll get you to dive into a little bit about what the rules are about that, because I know you know those pretty well.
Yeah, so I think you put me on the spot. You're the finance guy. So before, or what used to happen before was, you could have 5% down up to 5%, 5% down up to 500K. And then it used to be 10% on the remaining balance between 500 and $1 million. Okay. And then it used to be that anything over $1 million, you would need that 20% down. And for a lot of people, they could afford that mortgage on something over $1 million, but the problem would be their down payment amount. Exactly. So that recently got changed, and I believe the cap now is 1.5 million on the 10% required amount. So basically, they just moved the goalpost from $1 million to $1.5 million on the down payment requirement. So there's there's some pros and cons to that. On one end, you are responsible then for a larger mortgage. However, you can maybe stretch a bit to get into a different product. At the time, I remember recording these episodes with you. We thought that the product that would help the most is, like, let's say the $1 million to like 1.1 or 1.2 product, just because, again, it just helped you qualify for that if the down payment was kind of your limiting factor. Obviously, the market's been a little bit more challenging over the last little bit, so I'd be curious to look at the data to see if that type of product is still moving. Or moving as much. But yeah, so those are the rules now, and I'm sure there's some other ones, Cole, that you can clean up the the gray areas that I've missed out on.
Honestly, no, that was really well said. So Austin's right, 5% on the first $500,000, so half 500,000, and then 10% on anything over that. So realistically, you could put 125K down on a $1.5 million home. Now you're going to be carrying a large mortgage. It's almost a $1.4 million mortgage, but technically you can do that under the mortgage insurance rules. So all in all, like, you don't need 20% to to buy a home. It's not a requirement. But if you are going to buy something for over $500,000, you do need to put 20% down. Where that sweet spot is for you in terms of how much you put down is going to depend on how much you have available to you, as well as how much you're comfortable paying on a monthly basis, because that's really going to be your biggest thing. If I put an extra this much down, that means I only have to pay this much a month. But with the other side of that, if I put everything I have down, I don't have any savings, or I don't have any extra funds if I want to make some renovations, or I need to furnish my place because I don't want to be sitting on a camping chair with my TV sitting on a milk crate. You know what I mean? Like, there's things you got to consider here. So all this is to say, you don't absolutely need 20% down to buy a home, but if you don't put 20% down, there will be an insurance premium that you are required to pay, which gets added to your mortgage. So
I think one of the important things to add here as well, and we were just having a conversation about this off the air, is for first-time home buyers as well. Obviously, this can change a little bit with 25 or 30-year M. So let's add this. I know this doesn't necessarily debunk that question, but I think it's just useful info for right now.
Absolutely, yeah. So I'll touch on that a little bit more. Austin's right. When it comes to first-time home buyers purchasing with an insured mortgage, they do have the option to extend to 30 years, which typically you'd only be allowed to do 25 years with an insured mortgage, which is also a more recent change, which again helps with your monthly cash flow. It can help keep that payment a little bit lower. And why that's important is because, going back to this myth itself, is if you do put 20% down, you do have the option typically to go to a 30-year mortgage. So these things all do tie in. There's lots of nuanced things that it's our job ultimately to know and to help you guys with if you are a first-time home buyer, if you're any type of buyer or anybody looking to get a mortgage. These are the kind of things that we can help you with. So yeah, don't need 20% down. Myth debunked.
All right. On to myth number 2. Pre-construction homes are a better investment. Cole, why do you think that pre-construction homes are a better investment?
I'm going to answer this differently. So I'm going to answer this like this. Why might I think that? So if I'm a buyer, I might think that because of a few things. Number one, it's brand new. Of course it's going to be worth more. Like if I'm thinking about a cars and you roll up with roughly the same car, one's brand new, one's not, I'm going to assume the brand new car is worth more. Does that mean that's the same for houses? No, I'm not saying it is, but that's what I'm going to think as a buyer. I'm like, oh, it's brand new. Of course it's a better investment. It's going to be worth more. It's going to hold its value longer. Those are the kind of things that I'm thinking of. All the appliances are new. The finishings are brand new, all those sorts of things. But Austin, why might that not be the case?
Yeah, so I think something that comes to mind, in my opinion, I see the pre-con market being busier when like current inventory is hotter. So like, let's say hypothetically, you're thinking of getting into the market, stuff is moving quicker on resale. Maybe you're looking at pre-con and say, well, maybe for 5% down or 10% down, I can continue to save up on my down payment as things go and have somewhere to live in 2 or 3 years when I actually plan on moving out or something like that. A lot of people think as well of brand new, there's going to be nothing wrong with it. Everything's brand new. It's perfect. Another misconception with this is, oh, I don't need an inspection on a brand new home. You would be shocked how frequently inspections are done on brand new builds and stuff gets missed or corners are cut in some capacity, or maybe, I don't want to accuse builders of, cutting corners. That isn't it. But maybe insulation wasn't put in above the garage on a new build or something like that, and it just got missed, and it is like an innocent mistake. So I think that's one thing to think about. You obviously do pay a premium in a lot of cases for pre-con or brand new. There's other fees with that, of course. You're paying GST in some cases. I believe in some capacity there's going to be a credit now. That's for another episode. I don't want to go too much into the weeds on that. I'm not totally against pre-con. one thing I think that it's really valuable for, if there's a project or a development in a certain area that you really believe in, or where it's really where you want to be, that I think it totally makes sense to forecast for a couple of years to make sure you end up there. I remember, as an example, there was the first townhouse complex in Fort Langley. Really nice finishings, really quality builder, and those got scooped up because, again, it was the first of its kind, and a really great product at a really interesting price point. As far as a better investment, that really depends. Like, if you're looking at something for a rental right now, there's a lot of stuff that you can get that's available to you right now, and price per square foot, or just price overall. It might make more sense to get into a product now that, again, you can start renting out immediately. So investment, I think, in order to answer this question, I would need more information on what the person means by investment.
Yeah. Absolutely. I think that's really well said. And there's two things that came to my mind when I thought about this, and you kind of touched on it. Number one is, not all buildings are the same. So just because it's a pre-construction and ultimately will be brand new when you move in, doesn't mean it's going to be a better investment. Like, you may have a unit that's 5 years old that has nicer finishings, that's a more reputable developer, and because of that, it retains its value better for whatever reason. You know what I mean? There's a lot of those factors that play into it. And I think that's what you're saying, Austin, is that without knowing the specifics of it, it's really hard for me to say what the better investment is. And then number two, it's, if you are buying it now, and let's say it doesn't close for a few years, you don't know if that home is going to be worth more, the same, less when it finishes, right? Like, maybe it's not a better investment. Maybe it's a better investment to buy something that's ready now, and maybe that ends up holding its value better. So it's hard to know for sure, but I think the main thing here is that there's no guarantee that because it's going to be a brand new place that it's a better investment.
Yeah, I think that's something we've even seen recently for pre-con builds right now that people purchased 2-3 years ago. We're seeing appraisals come up short. People are having to add money to their deposit to get funding for a mortgage, and I know, like, that's, again, we could do a whole nother episode on pre-construction or or pre-sale mortgages and stuff. So again, we'll save that for then. But you just need to be mindful of a lot of things if you're thinking pre-construction, and that might be worth having a further, deeper conversation individually, as opposed to listening to us for 5 minutes on a podcast. So
yes, there's more to do for sure.
Yeah. So Cole, are you stuck with a mortgage until the term is over?
No, you're not. And it doesn't mean that there's no cost necessarily to getting out of that mortgage. But in general, I should rephrase that. In general, you're not. There is select mortgages that come with certain terms, like a term that gets used, and it's a little bit scary, honestly. It's called a bona fide sales clause. And what that means is, if you do try to break your mortgage early, you can only do it when you sell your home. Now, the only reason you would ever, I shouldn't say ever, the reason to go into that type of mortgage is typically it's going to come with a better interest rate, and you know exactly what that clause means, and you're prepared either to see out that mortgage, or you know that when you're ready to break that mortgage, you're going to do it because you're selling. So that's when you would use something like that, but it's something you have to be careful about and know what you're getting yourself into. And that's why you have to work with a broker that understands what that means. And it's not just, hey, it's a better rate because you chose this mortgage. Well, now I'm looking to break my mortgage and I can't do that until I sell my home. And that would just be an absolute nightmare. So this is all to say that no, you're not, in general, you're not stuck with your mortgage until the term is over. But with that being said, there is going to be some cost to break that mortgage. And that cost is going to depend on your lender. It's going to depend on what interest rates are at the time. And without getting too much into that, there's two different ways that lenders will calculate your interest penalty. And one of them is determined by what current rates are. So that can impact how much it costs for you to get out of that mortgage. But in general, mortgages are flexible in the sense that you can get out of them. You can borrow more funds, assuming you have the equity to do so. You can change your amortization so that maybe you bring your payment down a little bit lower. There is always some flexibility within your mortgage.
Very well said. Does a pre-approval guarantee you a mortgage? So this is number 4 of our myths that we are debunking.
Yeah. So yeah, you're right. That is number 4. Absolutely not. No, it does not. And you know what? I'm going to take this a step further, Austin. Approvals don't guarantee you a mortgage until they've been completed. So how the process works is typically, let's say Austin and I are working together. We've got a client that's looking to buy a home. They talk to me, Austin, which order doesn't really matter. And they say, hey, I would like to buy a home. I want to get pre-approved. So we sit down, we go through that with them. When I say we, it's me doing that part of the process. We get them pre-approved. We figure out how much money is in their wallet. That's a term that Austin likes to use, so I'm not going to take credit for that.
You're playing all the hits, my friend. Playing all the hits.
Exactly. Find out how much money's in their wallet. They go shopping. They find something they like. They write an offer. They get accepted. Now we take it to the approval stage where we now submit to the lender for an approval. The lender is going to come back to us and they're going to say, yes, you're approved conditionally based on X, Y, and Z. So as long as we meet those conditions and everything is satisfied, then at that point you will have an approval in place. Once that approval is in place and once documents are signed, at that point you can more or less guarantee that you're going to get a mortgage, assuming nothing materially changes. And that I like to say that because Austin and I have talked about this in the past, is like, what happens if you go out and buy a car in between when your mortgage approval is in place and you're closing? Well, technically your funding could change because now you have this other car loan that the lender wasn't aware of. If they're now aware of that, that could ultimately impact your ability to get money for a mortgage. So there's lots of little nuanced things, which is why using the word guarantee is tricky until you are in a place where the funds have transferred literally from the lender to the seller. At that point, you're guaranteed because the mortgage is in place. But up to that point, there's still things that can occur. And that's why it's important to know the do's and don'ts, I guess, of what you should do when you're getting a mortgage. And also understand that at baseline, a pre-approval doesn't guarantee you anything. It just gives you an idea of what you can afford based on the information that you've provided. Anything you want to touch on there, Austin? If not, I'm going to throw one right back at you.
Yeah, one thing I like to think about as well, that I don't think you mentioned this, was, just because you're pre-approved for a certain amount of mortgage doesn't necessarily mean that the bank wants to give you, that amount of money for whatever you want to buy. So what I like to think about as an example is, this spins off on what is an appraisal. Again, we won't touch on that. That could be a whole other episode. But let's say you're approved for $1 million mortgage or to purchase up to $1 million. If you go try and spend $1 million on something that's worth $600K, the bank's going to say, we don't want to give you money for that, thanks. Because in the event that something does go sideways and maybe you, heaven forbid, you default on your mortgage or get foreclosed on, et cetera, et cetera, et cetera, a mortgage is an asset. And in a lot of ways, a mortgage, the way that they're structured, is also value assurance when you're talking about things like mortgage insurance and things like that. So in the event that the bank needs to take this asset back from you, they want to make sure that they can get their money back, because that's just how it works. So again, it doesn't necessarily guarantee that you're going to get a mortgage on the product that you want to buy as well. So that's just something to think about that falls into the bucket of does a pre-approval guarantee you a mortgage?
Yeah, that's really well said, because they're only going to lend you the amount that they think the property's worth, but inclusive of your down payment. So like you said, they're not going to lend you $1 million on a $600,000 home because they're never going to be able to recoup those costs. So that is very well said. The numbers, just because you're pre-approved for a certain amount doesn't mean you're going to get that amount if you purchase a place for less than that amount. But also with that, it doesn't mean you have to buy something for that amount. Like, just because you're pre-approved for $1 million doesn't mean you have to spend $1 million. It means you could spend up to $1 million, assuming that we can satisfy the conditions of the approval. But yeah. All right. So last one, guys, number 5. Austin, do open houses sell homes? This one's actually quite interesting to me, because I think some people might argue they do, but I'd love to hear your take on this.
Okay, so I'm going to turn this around for a question for you. So obviously this is a myth. Why, if you are a seller, why are you wanting an open house for your home?
If I'm a seller and I want people to see it, I want traffic, I want to generate buzz, like ideally I want more than one person to come in there and be like, oh, I love this place, and them to write an offer and now have competition. That's what I want as a seller.
Mm-hmm. Yeah, very, very well said. I think when I think about this one, can an open house sell a home? Absolutely, it can. From my experience, however, the people that are actively purchasing or out there seriously looking to purchase a home are probably booking an individual appointment through their with their realtor to view the home. At open house, and with that being said, sometimes those people will come through just an open house if that's an available time slot to view it. However, a lot of times at open houses, you'll have neighbors come through. You might have somebody that's, maybe likes the place and would consider moving to it, but probably aren't in a position to move into it at the time. You're probably going to have some of those people. So it can. I don't think that it's necessarily the end all be all. A lot of times too, and I don't think this gets talked about enough, is there's a lot of risks to hosting an open house. I have conversations with people all the time. It's like, hey, like if there's going to be potentially strangers walking through your house, make sure to hide all your valuables. Make sure you're taking things like your calendars down so people don't know when you're showing up and leaving. Hide your TV remotes, things like that. Like there is a long list of prep of conversations and just things that you should be doing if you are having the public into your home. At the peak of the market, 2021, 2022, you'd have in some cases like 30 groups of people through a house, like in an open house. And that sounds crazy, but if the average size is maybe 1.5 or 2 people, that's like 45 to 60 people through your house in like a 2-hour span. Like that's crazy. We're not necessarily seeing that right now, but when you start to think about things like that, you don't know if there's people that are going to try taking things like that. So definitely some pros to open houses, definitely some things that you want to be mindful of as well. Can it sell a house? Absolutely. There's definitely people that have come through an open house of mine that ultimately want to end up purchasing that home for sure. I think it's absolutely necessary. I don't know. But it doesn't hurt, but I don't necessarily think it's the end all be all that you absolutely need to have one. So,
yeah, I think that's well said. I think this one's a bit of a trickier one because it can, like an open house can sell a home, but it's not necessarily going to be the reason. And I think the biggest takeaway from what you just said, at least that I got, was it's the people that intentionally make appointments to come see the home that are likely the most serious, and they're the ones that are more likely going to be the ones that purchase the home because they've found that home, they've sought out an opportunity to see it, and if it ends up matching what they're looking for, there's a better chance that they're going to be the ones that buy it. So yeah, I think that's a tougher one to debunk, but I think that it's fair to say that it's not just because you have an open house, you're going to sell the home. Because here's another thing, Austin, and you know this full well. Some places don't have open houses, right? Like some people, when they sell their homes, they don't have an open house. Does it mean their homes don't sell? Not necessarily. It just means that's the choice that they made. Maybe it's a prestigious property where open houses don't really make sense because they don't want to have a bunch of looky-loos coming through a multi-million-dollar home. And I think that's another point that might be worth noting as well.
Yeah, I think you have to be mindful of your product as well. And what I mean by that is, if you have we're not able to, double end deals, we call it. So we can't represent the buyer and the seller in a transaction. However, a lot of first-time home buyers, maybe they're just out casually looking at open houses online. And maybe if you're in a 2-bed, 1-bath, $500,000 condo, you might have some first-time home buyers that come through that aren't necessarily working with anybody, that are interested, want to get more information, et cetera, et cetera. However, if you're in a $3 million home, Probably not a lot of people that have never worked with an agent before that are just out of the blue being like, I feel like spending $3 million today. Let's go check out that open house. So just also being mindful of your product. I'll give you another example. There's a lot of people that only want to move if the right place comes up. And a lot of people too, like I have tons of family that are like, oh, well, we didn't want to bug you to go to a showing. So, we just wanted to go through the open house, right? So you kind of get that looky-loo traffic as well. But again, those people, a lot of times, if they only want to move for the right place, probably have something to sell. And if somebody is subject to sale, or they still have to get their house ready to be on the market, like, in some cases we can get people prepped or I can get people prepped and ready to go within a couple days, depending on the state of their house and what's going on beforehand. For some people, it could be a month, 2 months before they get on the market if they have to declutter, do their upgrades, their paint touch-ups, all that kind of stuff. So it's a big, giant, it depends. And again, if people are 2 months away from being able to actively pursue your house, and that's who's coming through the open house, you're probably hoping to be sold by then. So just something to be mindful of.
Yeah, no, I think that's really well said. I think we should probably get some attire that says, in quotations, "it depends," because that's something that comes up in our industry a lot. It's like, well, it depends. It depends on this and this and this. Sometimes it, like you said, it's as easy as quick turnaround in a couple of days. Like I'm thinking from a pre-approval perspective, like you can turn that around in a day if you give me the information I need, but it depends ultimately, right? So anyways, a little caveat there, but
that'll be our next podcast, the It Depends podcast.
Yeah, it depends. Exactly. So yeah, guys, that's 5 myths that I think we did a pretty good job debunking, or at least giving some more information on what the reality is for some of those things. And as always, guys, if you have any questions, feel free to reach out. Austin, anything else you want to add before we wrap this one up?
No, I think that's perfect. Thanks, guys, for joining us for another episode. We will see you next time.
Take care.